Hi guys, and welcome back to the channel, and happy Sunday to all of you. So today I thought why not to go live again, try to get better at it. So yeah, please bear with me. And bearing is a good segue to the market we're in at the moment, because really it truly is a bear market, and I guess all of you are feeling the pain one way or the other. I mean, I used to be so excited looking at my portfolio in the morning, but now the last few days, weeks and months, I mean, it's just been red all the way, and I guess most of us are in the same situation. For a while we've been moving sideways, but now really we're starting to go downwards as well, and it is really a pain and definitely a bear market. So I thought it would be interesting to kind of look a little bit about the history of bear markets, right, and where we come from. I mean, when we look at the S&P 500, the 500 biggest companies in the US, obviously. So for almost the last 100 years, we've seen around 26 or so bear markets. So here it's quite interesting where they break it down over the various years, and we can see here since quite a while and how long, what's the length of each of them is. So you can see some of them almost up to a year, 250 days, and the decline was up to 44-45%. So in that way, we're actually still not quite there. So when we look at the S&P 500, it hasn't dropped that much yet. So we're not really quite at the severe recession that we had in previous years. You see here some of the years was 61%, and some of the length was over 400 days. I mean, that's a while. So we haven't quite been there. I mean, I would say really it started at the beginning of the year. So far it's been 5-6 months that we've been there. Let's see how long it will go, but really interesting. In 2000, the dot-com bubble obviously, over 500 days. So that's close to 2 years. And when you speak to different analysts, I mean, some are saying even this recession, which hasn't really kicked in yet, right? I mean, we've seen the start of it, but certain situations like we have in Ukraine, in China, they haven't really fully played out yet. We haven't seen the repercussions. I think still to a certain extent the economy is kept alive with a lot of subsidies and support from government, etc. So we haven't really seen the full picture of the impact of all these various factors. So personally, I still think there's going to be a much more red to come going forward. But this is a good reminder that the stock market, the crypto market, investing is cyclical, right? There's ups and downs, and that's just normal, and it's something we as investors have to learn to deal with. And I mean, it was nice in 2020, 21 when everything was just mooning, and whoever put money on anything basically made a gain. But these times are a little bit now coming down, but I personally think that's a great buying opportunity, obviously. And will be interesting to see how it develops. Nobody knows the future, of course, but nonetheless very interesting. So let's look at S&P 500, where we've come from year to date since the beginning of the year. We're down 13%. So when you compare that to some of the downtrends we've seen in previous years, we're really nowhere near the drops we had in previous years. So that's actually still pretty good in that way. For the 1 year, we're only down 1%. Obviously, last year we had a huge growth in the S&P 500. I think it was close to 30%. And now we are so basically pretty much back to where we started last year. But again, looking at 5 years, we're still 70% ahead, and over 10 years, over 225. So, I still think that dollar cost averaging into the S&P 500 is the best way you can really invest in these times in the S&P 500. You can't go wrong with that. Over time, you're going to be doing well. Let's look at gold, because everybody says, well, gold is the place to be, to store value, and that's safe and so on. At 5 years, it looks really nice. I mean, definitely a growth of 46%, even though technically, if I factor in the inflation, it looks differently, but still 5%, 5 years and 46% growth, not bad at all. Now, looking at 10 years, it's a different picture, because in 10 years, actually, you only grew by 13 or let's say 14%, which once again, if you take inflation into account, I mean, technically you're going to be losing even with your gold. So it's supposed to be store of value. Not quite sure, and I made a video about my opinion about gold, which I'm not the biggest gold bull, that's for sure. And year to date we are in a slight plus, and for the 1 year period we're slightly down. So obviously, it keeps the value better in these times than some of the other stocks or even the S&P 500. Over the long time, though, I definitely rather be in the S&P 500 than in gold. Now another very interesting one is Coca Cola. I mean, Coca Cola is one of those really not very exciting stocks, right? I mean, they've been operating for, I don't know when they even started. I mean, it goes back to many years. The first stock was 92, but I think they even listed before. Nonetheless, now in difficult times, people say value stocks are coming back, right? Because growth stocks are all dropping and declining because there's less growth happening. So value stocks, companies that pay dividends, companies like Coca Cola that have a slow and gradual growth over time, and they have been doing very well. I mean, for one, they obviously pay a dividend of 2.72%, which once again, doesn't really cover your inflation, but it is a nice touch to get that. Don't forget, this is over the year. This is not paid monthly or quarterly. This is annually. Interesting, what's really quite fascinating when you look at the PE ratio, so that's the price to earning, at the moment that's a 26 multiple. So you paid the price 26 times that of the earnings. Now, when we go into Alphabet, which is Google, which used to, well, it is still a tech growth stock, and they normally value much higher the price to the earnings because of the future prospect earning. But at the moment, actually, they have a lower price to earning than Coca Cola. I mean, that's mind-boggling. Google has a lower price to earning than Coca Cola. So that just shows, once you enter bear territory, people are trying to flee into value stocks to get some sort of safety into their portfolio, and that comes at a price, right? So the price of those value stocks goes up versus those tech stocks really taking a beating. I mean, the same we've seen with Netflix, which is down by over 70% for the year. So Google, year to date, also down 22%. Now, at the same time, what does it mean? I think it's a great buying opportunity because, I mean, technically, since the beginning of the year, you dropped 22%. So you have a 22% discount on what it used to be, plus the PE multiple is cheaper than Coca Cola. I mean, if you're really a long-term believer and long-term bull in Google or other tech stocks, I took Google in this example, I mean, you have a big upside to go in the future. So now really, I think is a good time to buy, even though, of course, the question is, will it keep on dipping? And as I said before, I personally think it will. So I wouldn't put all my money right now if I was a Google bull right now, because I think I would rather dollar cost my weight down. So even as it keeps on dropping, I would consistently keep on buying to add to my position and lower my cost base of a particular stock. So I think that's really a good one to do. Now you may ask, what should I be doing in these times? And obviously there is no perfect answer. It depends on your investor profile. Some people are fleeing into gold, and if you think gold is good for your portfolio, then by all means go ahead, buy some. As I said, I'm not a big gold fan. So then a lot of people are buying either value stocks, or if they buy value stocks, they really focus on dividend stocks because you want this regular cash flow coming in. And I get this. I love cash flow. I think that's really something I want to do much more of, to have monthly, daily income paid to me passively. So let's look at some of the dividend stocks. So here are the 9 highest dividend paying stocks in the S&P 500. So that's quite interesting. And one of them is Philip Morris. So that's obviously a tobacco company. So first of all, you need to think of your own investment criteria. Is that something you feel comfortable with, investing in companies that may not necessarily do the best for the planet, but that's a personal decision. Nonetheless, obviously very established company, and they're currently paying a dividend yield of 4.8%. Now that's obviously very attractive and sounds great, but often the issue here is with dividend companies, the higher they pay a dividend, there's a reason behind, because they wouldn't be paying that high of a dividend if it was a super attractive stock that people would anyways want to buy. They often use this as a teaser to get people sort of into their company, buying into that, because otherwise either the earnings are not delivering or the future prospects are not looking great. So you have to be very mindful of this. So it's attractive for the time being to get this dividend return, but long term there might be a catch to it, that the stock price keeps on dipping for whatever reason. So what you gain in dividends, you may be losing actually in stock value. So that's something to keep in mind. And a couple of other ones. There is the realty trust, Vornado, 5.1. Quite often you see real estate stocks in there, because these are REITs, real estate investment trusts, and they pay relatively high dividend yield. once again, there might be various factors in it. I'm not going to analyze all of them, but just to give you an idea of what's currently out there, what is being offered. 5%, another real estate company, IBM. So that's a company currently paying 4.7, which as a technology company basically is not very common. Normally technology companies pay hardly any dividend. I mean, Google doesn't pay any dividend. Apple only recently started paying, but the very, very minor one, I believe, is less than 1%. So usually tech stocks don't pay a dividend because they reinvest all the earnings into R&D, research and development. They don't want to pay out investors because anyways they want to invest into the stock. So for IBM to pay 4.7%, I would be a little bit cautious. I would do a bit of a deeper analysis of the future potential. Then a couple of other companies here, but you get an idea. Anywhere from 4 to 6% is pretty much a very high dividend, I would say. At the moment, AT&T, another provider there. So all these things is an option, definitely. I think it can be something to invest in, and it's better than nothing, better than being only in tech stocks. And that's why I always say you need to diversify, right? And that's why I've recently more and more transitioned into just investing into S&P 500 because times are so volatile. I mean, a couple of years you might be doing extremely well with the tech stocks and they're booming and they're doing great, but then as we've seen before, bear markets happen, right? They happen every so often, and if they happen, you want to be in value stocks. So I don't want to be buying and selling and buying and selling because overall you won't be doing as well. So why don't you just invest in the S&P 500 over time, and you have the best of both worlds because it is weighted by market cap. So the more valuable value stocks come during this time, naturally you will have more weighting in that because you buy into an index. And that's, I think, just the simplest way you can be doing. You don't have to read constantly news, do market research, all these things. You're just gonna invest in an index, set it and forget it. Ideally a saving plan where you put a certain amount that you can every single month and let it grow, and then come back to it in a couple of years and you'll be good to go. So of course that's one way. What I do myself. Another hand, what I do, I've started this, I would say a year ago, and that's investing into cryptocurrency very heavily. And because mostly I love it for the staking rewards, because cryptocurrency right now is similar like the stock market has been absolutely on the path down. That's natural, right? I mean, it's just the overall market conditions. But what I love about staking, that is paid to me basically like a dividend. But not every quarter, like most dividends are paid, but instead every single day. And the rewards are significantly higher. So as you know, I'm a big fan of Nexo, and I just pulled this up over here. These are the staking rewards I'm getting on my cryptocurrency. So basically what it means is you put your cryptos to work. They either lend it out or they give it to institutions who kind of use that to leverage or other things. There's a different ways how we can get staking rewards. We don't want to talk about the technicalities in this video, but basically what you can get on your cryptocurrency you can see over here. So there's two ways. You can either earn in kind, so that's basically when, for example, I use my Bitcoin. You can see over here I would be getting 6% on my Bitcoin, the interest per year, but paid to me daily. So that would be paid in Bitcoin. Now if I want to earn in Nexo, I would basically get 8%, so there's an incentive of additional 2%, but instead of getting those 8% paid to me in Bitcoin, I would get them paid in Nexo. Now that's a personal decision you can make for yourself. I prefer to get the higher rewards because then I can start building up my Nexo holdings, which helps me to keep a higher loyalty member in Nexo. So the higher your loyalty member in Nexo is, the more benefits you get for other things as well. Plus, I can, of course, anytime when I think the Nexo price is good, I can just quickly, with a click of a button, convert it and then either cash it out in euros and use it in my bank account, or I can convert it to Bitcoin, what have you. So definitely I would strongly recommend to get the additional earning reward. And so far I'm close to 150 euros that I've earned so far since a couple of weeks that I started. My goal is to get $10, 10 euros per day in staking rewards, which will be 300 euros per month. And you need to have a lot of stocks in dividend stocks, shares in dividend stocks, to get 300 euros a month. I mean, that would be a significant amount of money. And don't forget, I also have a couple of coins such as Polygon, Matic, where I'm getting 16%. So I don't know actually any company that pays a 16% dividend. And so yeah, I really do believe that staking is the new dividend kind of in a way going forward. So that's what I continue to do. Plus, of course, dollar cost averaging both into cryptocurrency, and mostly I focus on Bitcoin because yeah, we've seen with Terra Luna recently, even one of the top 10 coins has the potential of going to zero. Though I believe that Bitcoin and Ethereum are here to stay. They will drop quite possibly further in the future, but I don't think they're gonna go completely to zero. That's just not gonna happen. They're really too big to fail. But as I said, we have seen so many other bear markets in the past, so I still think there's more correction to come. And you know, I'm just gonna dollar cost my average down basically, and try to build up as much positions as I can. So once the market rebounds and returns to growth phase, I can really capitalize on it and then decide, you know, do I want to take some profits and sell, or do I want to just ride it out and obviously keep on benefiting from those staking rewards. So yeah, that's my way forward. Let's see if we had any questions here. So far none. So yeah guys, I hope you enjoyed it. If you did, then please give it a like, subscribe to the channel. It really means the world to me. If you enjoyed it, also let me know. Then I'm planning to do more of these live streams in the future. I hope it wasn't too bad. I know I still have to get better at it. It's quite different than when you record and can edit all these ums and ams out. So definitely I need to improve that. But thanks for bearing with me and stay positive. Let's have a great week ahead. Keep